So let's finish up this topic on the use of credit scores for rating policies. And by rating policies, what we're saying is pricing policies, but pricing them for different people at different rates given what the actuaries see as different risk levels. And again, that relates to either severity or frequency or both. So let's walk through these studies and let's make sure we have everything down. Let's be a little repetitive, but just to make sure when you're developing your answer to the question about discussing credit scores and insurance pricing, what are some things that are really important? So definitely very important is to talk about the three types of discrimination. Again, I'm not real picky on the terms because I think they're a little mixed up, especially the first two, but unfair discrimination and intentional discrimination. Unfair discrimination is pricing different people, different prices without any actuarially justified statistics on frequency and severity. Intentional discrimination is discrimination based on race, color, religion, or national origin. That's illegal no matter what data says. And then disproportionate impact is when you have a basis for charging people different amounts, but because that factor has a correlation to race or national origin or age, it ends up disproportionately impacting certain groups more than others. It's not illegal unless, and this he brings up in his paper, and it's a very, very important point I may not have emphasized enough, disproportionate impact is not illegal unless the factor is 100% a predictive factor of race, color, religion, or national origin. So if you could take credit scores, and once you get someone's credit score, you know exactly what their race or their religion is, then it could not be used. And he has that. I love this phrase. If that's the case, if credit scores are almost a perfect predictor of a person's race or religion, he says it becomes a surrogate for something sinister. Isn't it just a great phrase the way he says that? All those S's in there. So, and what he discovered is that's not the case, because people of all races have high credit scores and low credit scores. People of all income levels have high credit scores and low credit scores. People of all ages have high credit scores and low credit scores. Obviously, people of high income have higher credit scores on average, but they do fill in the entire range. And certainly people that are poor have lower credit scores on average, but they also fill in the range. There are poor people with really good credit scores, amazingly, and there are very wealthy people with really bad credit scores, which is to me even more amazing. But credit scores have an outward appearance that there's something untoward, something illegal going on. So the commission study was to find out those questions, if the use of credit scores is legal in Texas. So it can disallow it if it's intentional or unfair discrimination. If it's disproportionate impact, it cannot disallow it. And so here's study one, to find out whether use of credit scores impacts certain classes of individuals more than others. That's disproportionate impact. And if it predicts claims experience. So remember, phase one was a univariate analysis. It just looked at credit scores versus frequency and severity of claims. So we gave you the two graphs, one for homeowners, one for auto. So those are important, and show that there's a strong relationship, much stronger with frequency than severity. So I would definitely get that into your answer, that frequency is really key. There is a disproportionate impact on race, income, and age. Age is okay. You can discriminate on age. Young drivers can be charged more than older drivers. What the issue here is, young drivers are charged more, but then if they have a bad credit score, they get charged even more. So it's almost like we're doubling down on them and really making it harsh for someone who's already has a limited budget. So there are people concerned that this is just kind of too much for already weakened groups. Phase two was a multivariate study looking for multicollinearity. And the question was, does credit score actually provide additional information over other rating classes? And we showed you all the rating classes in the in that table. Very interesting, all the things that insurance companies look at. So I have the word parsimonious. You want to be parsimonious. You don't want to add other factors if they really don't add any more explanation. But the study found that credit scores enables insurers to more accurately predict losses. Helps you understand frequency, especially in severity. So credit scores are not a surrogate for something unlawful. Use of credit scores is parsimonious. It does add value. It is efficient to add it. It's not a waste of time and effort. And they actually use these terms. These are their words. This isn't my interpretation of their words. This is the words. It significantly improves the pricing accuracy when combined with other variables. What do insurers say? Insurers say, yeah, use of credit scores may affect affordability. There are people with weak credit scores that are going to see their insurance premiums 40% higher than others. But if we didn't do that and we didn't make that distinction, rates, we would just not be able to sell the insurance. So using credit scores improves availability, at least for those people who are in classes that generally get charged more, but they have good credit scores, they've been responsible, and we can provide those people insurance at a good price because they have good credit scores. So insurance companies talk availability, whereas those critical credit scores talk about affordability. Other views, use of credit scores makes, and here's that affordability, makes insurance unaffordable to some consumers, a pretty good, a large group of them. This is true not just of credit scores, but it's true of anything that the actuaries use in their pricing. From a society standpoint, statistically bad drivers may not be able to drive. So what does society do? These are people who need transportation, need to get around. Is public transportation sufficient? Are we just piling on someone who's already in a bad situation? We're just making it much worse by charging them more. There are false positives. There are good drivers with bad credit scores. There's also bad drivers with good credit scores. But this is what people are most worried about, those good drivers who just have to have a bad credit scores, but they drive well. So what's the solution there? And we'll talk about this a little bit later, maybe in the next session. And maybe telematics is, we might get to it tonight. I think I have an article out there on telematics. So we'll do it now. This is a good time to put this into the class. So we'll come right back to that. So if you have a false positive, you have a good driver with a bad credit score, what is the alternative? Well, one alternative might be public transportation. If it's not a false positive, they really are bad drivers. Isn't that better for society? Do we want to force insurance companies to make insurance affordable to people who have a lot of accidents? So there's one side of it. The other side is the false positives. So that's definitely a concern. There's good drivers with bad credit scores. So could telematics help them? So let's look really quickly at telematics. Telematics would be a good paper topic for paper 2. There's a lot out there on it, and it's a very, very interesting topic. Essentially, it's artificial intelligence and machine learning. It's data analysis. It's putting recorders into the car, keeping that information and using that information to figure out better ways of measuring who are good drivers and who are bad drivers from the information in those boxes. But not only that, but one thing I think is really interesting with telematics is people who have these boxes in their cars, the telematics actually tells the driver where they are dangerous. So it may actually be helping bad drivers become better drivers. I told you earlier in the semester that TV series where they're trying to find the worst driver in Canada, and that's a really interesting series of the distracted drivers who stop too quickly or jackrabbit, just really fast, speed up at lights and stop signs. And so telematics can actually help those drivers know what is it that's causing them to be more risky for their rates to go up, and they can actually change their behavior, which not just helps them get their rates lower, but actually reduces the number of accidents. So about 80% of drivers, this is an Economist article. I have a link to it in the notes, but you probably can't get to it because you have to you have to have a subscription to The Economist. So I need to copy this and put this article into a Word document. But you can see it here. Around 80% of drivers think of themselves as above average, which obviously is really not possible. So obviously we have a higher opinion of our driving than we really should. Underwriters have used different ways to try to assess whether someone is going to be a good risk or a bad risk. Age, location, sex. Women are generally have fewer accidents than men, so men pay more for auto insurance than women. So if you can put something in the car that actually helps you understand who the good drivers and who the bad drivers are, and you can actually get a 10 to 40% rate reduction, premium reduction, then maybe these drivers with bad credit scores, that's the way for them to prove that, hey, I really am a good driver. Give me the box. Let me demonstrate that I'm a good driver. Give me a 40% discount because I've been using this box. And the question is, if you use the box and collect the data, and the data helps you rate the driver, was that driver really that good of a driver, or did they change their driving behavior because they had that box in the car? Or is it that the box actually communicates back to the driver? Is the box actually making the driver a better driver? It's not that the driver is performing the driving function better because they know they're being monitored, but that they're improving their driving because of the feedback. There's been other approaches. I think this one's kind of a strange approach, but there's an advertising campaign said drive like a girl. I just can't imagine that would be an effective tool to use with 18 to 20-year-old men. But so interesting campaign, but definitely the data that we have and trying to get people to change their behavior with these different marketing campaigns or telematics or whatever, you can see, and that's why I say this is an interesting topic for our paper, is how has the insurance industry changed how dangerous it is to be driving on the road. They've changed the way cars are built. Now they may be actually changing how people drive. And obviously distracted driving is a huge issue now. That would be a great topic for your second paper if you haven't found one yet. Distracted driving has obviously greatly increased frequency of claims. So what can we do to fix that? And so telematics may be it. The fear of telematics is insurance companies will use it to cherry pick their customers. That maybe telematics is so good, insurance companies know who the good risk are, they know who the bad risk are, and they just don't insure the bad risk at all. There's other benefits to telematics. You can identify a scam. If someone says they suffered a heavy whiplash, but you know for sure that the car wasn't hit that hard for that to happen. It might improve driving, as we talked about. There are some privacy implications. There are issues that if telematics knows exactly where you were at all times, that can be used against you in a criminal case or anything else. So there's some issues there. So Progressive only stays plugged in for 6 months to get a snapshot of the driving, and then after that the discount is permanent. I've been tempted. USA does provide this, and USA is my insurer. I've been tempted to try telematics and just see what it was like, and just really to see what are those things that I could do to improve my driving. It's interesting with my latest car. It's a Prius Prime. Whenever I shut the car off at the end of my drive, it actually gives me a score on how well I drove. I used to forget to look at it, but maybe once a week I remember to look up and see what my score was, and it will say, hey, good job on this, you need to improve this. Very, very interesting. So obviously we're going to talk in the next session about autonomous vehicles and the impact that could have on the insurance industry. The world is changing. We're discovering with artificial intelligence and machine learning that there's ways we really can improve how insurance companies assess risk. So, we talked a little bit about this. What does credit score have to do with driving? And we got to remember that correlation does not mean causation. So just because A and B are highly correlated doesn't mean that A causes B. If someone says, "Wow, every time I put a bucket out in the front yard, and every time it rains, I notice the bucket has 3 inches of water in it." So I've determined that whenever the bucket has 3 inches of water in it, it causes it to rain. Well, that's backwards. The causation's backwards. I think with credit scores and driving, it's not that good driving causes good credit scores or good credit scores causes good driving. I think, and most of my students, when we talk about it in class, agree something very similar, that what it is a third factor, whether it's responsibility or conscientiousness or whatever, that there's a third factor, and people with that characteristic have both good credit scores and tend to be good drivers. But actuaries don't care. Actuaries are looking for correlation. They price off a correlation. They don't have to prove causation. So credit scoring has earned outward appearance of being something surrogate for something sinister, but this study shows that no, actually, it's probably a surrogate for something quite rational, like how responsible a person is. And there's no other way to measure that maybe than credit scores. All right. Some background information, how material is the premium? So we looked at that. We talked about pure premium and loss ratio. We talked about the risk-based pricing and underwriting. Underwriting is just insurance companies determining who's a good risk and who's a bad risk. And the one thing I haven't mentioned, I mentioned that the guy from Allstate was being interviewed on WOII. People were calling in and saying it was unfair. They should not use credit scores anymore. Very important to remember that if we stop using credit scores, everybody doesn't win. Drivers with bad credit scores win. Their premiums will drop 40%, but drivers with good credit scores, they lose. Their premiums would go up 40%. So there's not going to be all winners. It's not like insurance companies are charging people with bad scores much more money, but continue to overcharge people with good scores. They're actually reducing the premiums of people with good credit scores. And so they would actually be penalized if we did away with credit scores. All right. So there's the questions answered in the study. There's the telematics article. So just real quickly to end this up, can a good company say, you know what, we don't like credit scores, we're not going to use it? So the good company charges everybody. Let's look at single versus married drivers. That's one of the factors. A good company says, we don't want to discriminate against single drivers, charge them more than married drivers, even though the data supports that people that are married drive better than people that are single. Let's charge them all $500. The evil company, I'm being a little facetious here, they look at the analysis and they just discovered that they should charge married drivers $300, that's the pure premium, and single drivers $750. So what's going to happen? Well, all the single drivers are going to go to good company. Good company is going to experience pure premiums of $750, even though the pure premium they charge is only $500. They're going to be forced to raise their prices probably above $750 because they got to recoup those prior losses. Then those drivers are going to go to the evil company. All of the married drivers have already been going to the evil company. They pay $300, and that's $300 was expected. The good company has no choice. They either have to start charging the right rates, or they're going to get all the bad drivers, and their experience is going to be much higher because they're charging based on the average of single and married drivers. But if all they get is single drivers, their claims are going to be much higher than what they charge. There's no way to stop the use of this in pricing unless the state comes out and says it's illegal. Like the state of California came out and said you cannot use credit scores. So we looked at the Allstate article. All right, so one last thing we'll do with auto insurance. We're almost finished with auto insurance. I do want to talk about auto safety, and there's a few videos I want to show. I have trouble showing videos in a video, so it might be we'll have a video inside a video but without the sound, just with the picture. But I can tell you what's going on there. But if any of you are looking for a topic, here's a great website. The Institute for Highway Safety is very closely tied to the insurance industry. Their job is to see if they can make cars safer. So at least the severity of accidents is greatly reduced. I would encourage, if you're buying a new car, especially if you have a family, check out this website. Consider car safety as one of the factors that you consider before you buy a car. So that's where we'll start next time. Thanks.